Okay, good morning, guys. Welcome to the accounting media for the third day of our revision class in preparation for the Institute of Chartered Accountant of Nigeria examination November 2021 diet. And for the past few days, from Friday, we have discussed some things pertaining to how to solve some questions how to solve some questions. And today we'll be we'll be talking about short-term decision making. Short-term decision making. This particular topic is such an interesting but a tricky one. So I would advise that we listen attentively, and we'll be solving some past questions and see how questions are being answered So we start. What is a relevant cost? What do we call relevant cost? What is a relevant cost? Now, before we move on to what a relevant cost is, in business make short-term and long-term decisions. They make long-term and short-term decisions. And when you are making long-term decisions, you need to know how viable that decision is. You need to know how viable that decision is. And we know too well that when we are making decisions, there will be cost implication of that particular decision. However, it's not all costs that are relevant to a particular activity. It's not all costs. So first of all, we need to establish which of the costs is relevant. Which of the cost is relevant. And for us to be able to know which of the costs is relevant, we need to ask ourselves so many questions. So many questions. And those questions depends on what we want to get. What do we want to achieve? But if we can get to understand all of these principles one by one, it is going to go a long way in answering, even if it is a two-page question. So now, what do we call a relevant cost? First of all, a relevant cost must be a future cost. It must be a future cost because it must be a future cost. That is a cost you are looking to incur, a cost that has not been incurred. So if you have incurred a cost and you now want to make a decision based on that, it is not a relevant cost because either you alter that either you alter the decision or not. You've incurred that cost, you've incurred it already. There's nothing you are going to do. So any cost you've incurred in the past, they are totally irrelevant. They are not relevant. A relevant cost must be a cash flow. A relevant cost must be a cash flow. That is, it involves the movement of cash. Don't forget, cash is different from profit. Cash flow is different from profit. And as such, in this case, what we need is cash. So any cost that does not involve the movement of cash, say the likes of depreciation, notional cost, it should all be ignored for decision making purpose. However, there are some cases whereby depreciation will be irrelevant, but we will get there. Just hold it. The first principle is that relevant costs are future costs. Relevant costs are also what? Cash flow. And also, a relevant cost must be an incremental cost. It must be an incremental cost. That is an additional cost. Because if you have a cost that regardless whether you make a decision or not, you are going to incur that cost. It is not an incremental cost. So an incremental cost is a cost that when you make that decision, it's going to make you spend more. It's going to make you spend. It is an incremental cost. When you make a decision, you are going to spend. It is what? It is an incremental cost. Relevant costs are unavoidable. They are avoidable rather. They are avoidable. Please note that relevant costs are avoidable costs. Avoidable costs in the sense that if you don't make that decision, you are not going to incur that cost. If you don't make that decision, you are not going to incur that cost. That is what we mean by what? Avoidable cost. A cost that, okay, you want to say you want to, Mr. A wants to cook, he wants to bake cake. So the idea is if he is not breaking that cake, he's not going to buy the ingredient for cake, and as such, he can avoid that cost. But because he's going to bake that cake, he needs to what? He needs to incur cost. So if his decision is that I'm not baking cake, he can avoid that cost. And as such, it is a what? It is a relevant, it is a relevant cost. Also, relevant costs are differential cost and opportunity cost. Differential cost is actually the difference in total cost between two alternatives. Difference in total cost between two or more alternatives. So now what do we mean? What we are trying to say is I want to look at, I have three alternatives with me, and A is 1 naira. I have two alternatives. A, I'm going to spend 15 naira. B, I am going to spend 100 naira. Now I need to look at the two together and see what is the difference in cost between the two. What is the difference between what? Between the two. That is what? That is the differential cost. What is the difference between two alternatives? The difference in cost between two alternatives. One opportunity cost. Opportunity cost is the alternative forgone. Alternative forgone. So now, alternative forgone is saying you have so many things on your list, but you choose to do some while you are not doing the others. The others that you are not doing, that you are leaving undone, because you have to do something, is what we call the what? Is what we call the opportunity cost. It is what we call the opportunity cost. It is what we call the opportunity cost. Now, specific and directly attributable fixed costs are relevant costs. So basically, fixed costs are not relevant costs, but specific or directly attributable fixed costs, they are relevant. So now, general fixed costs are not relevant. General fixed costs, that is, these are the costs that either you produce or you are not producing. Either you are making that decision or you are not making that decision. It is still going to be there. It is going to be there. But attributable fixed costs or specific fixed costs are what? Are directly attributable fixed costs or specific fixed costs are what? They are very, very relevant for decision making. Very, very relevant for decision making. And all of these principles are what we should hold because it's going to help a lot while we are solving questions. So what are irrelevant costs? Irrelevant costs are costs that are not affected as a result of decision taking. They are costs that are not affected as a result of decision taking. They are costs that cannot be saved regardless. The first of it is sunk cost. Sunk cost, another name for sunk cost is past cost. Another name for sunk cost is what? Is past cost. Past cost. So past costs are maybe you've incurred a cost in the past and you're now saying you now want to do something. You're now saying, oh, I want to make a decision now. You are now treating the previous cost as what? As a relevant cost. So let's take for example now, you want to identify a product. You now spend money on research and development. After spending money on research and development after like a year ago, you now want to start, maybe you now abandoned it. You now want to start that research, you want to search about that product again. You are now calculating the previous money you spent on research and development on that thing you are doing now after you've abandoned it for a while. So the thing is that kind of cost is a what? Is a sunk cost because either you continue with that decision to make that product or not. You have incurred that money last year. It's not going to change. Nothing will change whatsoever. So it is what? It is a sunk cost. and some costs are irrelevant costs for decision making. Also, a committed cost, a committed cost, a committed cost also it is an irrelevant cost. It is an irrelevant cost. And lastly, general fixed overhead cost. Cost that is general to the organization, they are what? They are irrelevant. They are irrelevant. So there might also be some variable costs that are what? That are irrelevant. Variable costs that are what? Irrelevant. And this many a times happen when you have something called capacity. When you have capacity, don't forget, traditionally, unless when you are solving question on throughput, again, traditionally, only if you are solving question on throughput, labor cost and material cost are variable cost. But when you get to throughput, the only variable cost you have is material. So let's say you have a worker that you pay money, you give wages, and this worker has not been doing anything, that's been idle. Don't forget, labor is a variable cost. But if your workers are idle and they are not doing anything, and you are taking them to help you do another thing outside the primary job, you are not going to count them as a what? As a relevant cost, because they were idle. So there are cases like that whereby variable costs are irrelevant cost also, but it depends on the story around such a cost. Around such a cost. It depends on story around such a cost. So look at this example. Look at this example. They say suppose that a company has some units of raw materials in inventory. Suppose it has a raw material in inventory. They've been paid for already and the original cost is 2,000. Don't look at this statement. This material has been paid for already and the original cost is what? 2,000. It is a sunk cost because you've paid it in the past and the original cost is what? 2,000 naira. When you see things like this, you do not need that figure whatsoever. You do not need figure like this at all. Now, they said they are now obsolete and they are no longer in use in regular production and they have no scrap value. However, they could be used in special job which the company is trying to decide whether to undertake. The special order is a one-off customer order and will use up this material in inventory. You have to decide. In deciding whether the job should be undertaken, the relevant cost of material to the special order is nil. Why? Because they are not okay. Let's go down and explain it. We'll now come back to it. Now, like I said yesterday, in the course of our lecture, that we have four components of cost or four elements of cost, as I used to call them. Now, these elements of cost are basically what we work around with in this course. Take a look at it from your ABC. We are still talking about the element of cost. ABC is just hammering on overhead. Look at standard costing. We are still working around labor, material labor, overhead, and sales. That's what we are working around. Now, if you look at it now, what is the relevant cost of material? What is the relevant cost of material? The relevant cost of material depends. Now, when you have a material, the first question you begin to ask yourself this question, material rather, are you available in store or not? Are you available in store or not? The answer can either be a yes or a no. So if this particular material is not in store, it is just reasonable for you to say you want to go and buy another one in the market just to be able to use the material. So if the material you want to use is not in your store, you go to the market and buy, and the relevant cost in that case is going to be the market price, the amount you will get it in the market. That is it. Or we call it current replacement cost. That is if it is not available. Now, if the material in question is available, if the answer is yes, you ask yourself again, this material, are you in regular use or not? What do you mean by regular use? What we are trying to say now is, do we use the material often? Is it something we use all the time? Is it something we still need? Is it something we don't need? If the answer to that question is yes, that is we need it, the the relevant cost is going to be the current replacement cost, because it is a material you will be needing, and for you to use it you need to replace it back. So if the answer to the question of are you in regular use or not is yes, that means you have to replace it because it is in regular use. But if the answer to being in regular use is no, then the replacement cost is going to be what? The higher of the current resale value, or the value it would obtain if put to alternative use. Now I will explain this. The current resale value is just talking about, if I want to sell this material because it is not in regular use, how much do I sell it? Then you compare it to, okay, what is the value I would obtain if I was to put it in alternative use? Now, I have a bakery. I am making bread. I now have flour. Maybe my bakery now, we are not working again. We are not selling bread again. I want to make cake. Now, what is the value I will get for using that flour to make cake? I will now compare it to what is the value I will get if I was to sell that particular flour to another person outside. I will compare the two, and that will be my relevant cost. So you need to keep asking yourself those questions. The first question is, material, are you in store or not? The answer can either be a yes or a no. If it is a yes, it simply means you have to replace it back. If it is a no, you have to go to the market also to go and buy the same material. Now, if the material, you now ask the material, are you in regular use or not? If the material is in regular use, if it is in regular use, you ask, is it, if it is in regular use, if the answer is yes, the relevant cost is going to be replacement cost, because you have to replace it. And if it is no, you have to take it, you have to do what? You have to compare the current resale value and the value they would obtain if put to alternative use. Now let's look at this Ayomide question. He said Ayomide has been approached by a customer who would like a special job to be done for him, and who is willing to pay 22,000 for it. A job that is being proposed to Ayomide to this company, okay, the job that is being proposed to Ayomide by a customer is a special order. Now, the job will require the following material. The job will need material A, material B, material C, and material D. Now, the total unit required for them to meet the customer's order, it will be 1,000 units of material A, 1,000 units of material B, 1,000 units of material C, and 200 units of material D. Now, here comes the question. Let's start with material A. Okay, they said units available in inventory. Then this question has begun to answer our question for us, small, little by little. We have 0 unit of material A, 600 unit of material B, 700 unit of material C, and 200 unit of material D. The book value, this is the historical cost. An historical cost in relevant cost is an irrelevant cost, because that is the original cost. And don't forget, the original cost has been cost that has been paid in the past. And another name for past cost is sunk cost. Sunk cost, is it relevant or not? It is irrelevant. So this column where we have the book value is very, very irrelevant. However, let's see. For decision making, it is irrelevant. What is the realizable value? This is the current resale value. The current resale value. Then we have the replacement cost. We have the replacement cost. Now, when we start with material A, look at it. Material A. Material A does not have any node because they said it has 0 units in inventory. And we ask, material A, are you in inventory? Material A say, no, I am not in inventory. Now, if you are not in inventory, what is going to be the relevant cost? If you are not in inventory, what is going to be the relevant cost? The relevant cost is going to be the market value, and that is the amount you will go outside to buy it. In this case now, is the replacement cost. I need material, I don't have. What do? I go to the market and get it, and that is the replacement cost. So for material A, the relevant cost is going to be 1,000 units multiplied by 6. 1,000 units multiplied by 6. 1,000 multiplied by 6. And for B, it's going to be, no, so we have footnote. Let's check the footnote for B. They say B is used regularly by Ayomide. Now, the question is material B, are you in inventory? Material B says, yes, I am in inventory. I have 600 units in inventory, but material B needs what? 1,000, which means we are still short of what? 400. Let's leave that. Let's hold that. They said if unit of B are required for this job, they would need to be replaced to meet other production demand. They would be need to replace under production demand, which means material A, material B, are you in inventory? Material B says, yes, I am in inventory. I'm in inventory. Okay. If you are in inventory, material B, are you in regular use or not? Material B says, wow, I am in so much demand and I am in regular use. And we say, if you are in regular use, what is going to be the relevant cost? Now, this thing is split into two. The relevant cost for 600, which is in inventory, is going to be the current replacement cost. The replacement cost. While the 400 we do not have, also, we have to go and get it in the same market, which is at the current replacement cost, which makes it what? 600 at 2.5 and also 400 at 2.5. So we have the total unit that will be bought at 2.5 is 1,000 naira, because even the 600 you have in the store, you have to replace it back, and it is going to be at the current replacement cost. It is going to be at the current replacement cost. So the relevant cost of material for B is going to be 2.5 times 1,000, and that gives us 2,500. 2,500. So for C, let's check the footnotes. They say material C and D are in inventory as a result of previous overbuying. They overbought material B and C. They overbought material B and C. Coming. Okay, we don't have any. They overbought material B and C. Material B and C was overbought, and they have a restricted use. That is, they don't really use them. No other use could be obtained for material C. No other, that is, material C is not in regular use. The answer to the question of material C, are you in regular use, is no. And if it is that, let's continue and see what they have for us in the footnote. But the unit of material D could be used in another job as substitute for 300 units of material E, which currently costs 5 naira per unit, of which the company has no unit in inventory at the moment. So let me start with material C. Material C does not have anything in, it has in inventory, but it is not in regular use. So if it is not in regular use, we said the relevant cost is going to be the higher of the resale value, and the unit will be derived for putting into alternative use. But C now does not have any alternative use. So the relevant cost is going to be the resale value. So if we had not used this material C to meet the customer's demand, we could have sold it for 2,005. And as such, our relevant cost is going to be the money would have sold it to an outsider, which is 2.5, multiplied by how many do we need? We need 1,000. We need 1,000, right? And we have 700 in store. 700 in store. So that means we still have shortage of 300. But the relevant cost of the 700 is going to be at 2.5 because we have sold it to an outsider for 2.5. So it's going to be 2.5 multiplied by 700. That's 1,750. 1,750. And the remaining 300 we have to buy it because it is not in store. So 1,750. So the one we have to buy in store is 1,002, which is 4 times the remaining 300. So 1,002 plus the 1,750 for the relevant cost of the one we have in store gives us 2,950. Gives us 2,950. Gives us 2,950. So that's the relevant cost of material. So let's check this question. They said the company, this classwork, they said the company regularly uses a material. It currently has 100 kg in inventory for which it paid 200. It has in inventory 100 kg and it paid 200. So the cost per unit here is 2 naira. That is the historical cost. If it were sold, it could be sold for 3 naira per kg. This is what we call the current resale value. The market price is now 4 kg. A customer has placed an order that will use 200 kg of the material. The relevant cost of 200 kg is what? Now, we take it one by one. How many material do we have in store? 100. How many do we need? 300. We need 200, which means we don't have 100. We have to go to the market to buy 100. And they now said the current market price, which is the current replacement cost, is now 4 naira, not the 2 naira we used to buy before. So it's going to be the 100 we need, the 100 we don't have in store is going to be at 4 naira, which is going to be 400. And the 100 we have in store, is it in regular use if it were to be sold? So this question have just told us, did not tell us anything about if it's in regular use or not. But from the way they just said it, it's not in regular use. They gave us the current resale value, and the current resale value is 3 naira. So if we are to sell it, the 100 we have in store, since it is not in regular use, and they gave us the current resale value and not the cost of putting it to alternative use. We are supposed to compare the two, cost of resale value and cost of putting it to alternative use. But since they just give us one, we are just taking that one. So it's going to be 3 times 100 plus the 400 we are going to pay for getting it outside. So the relevant cost here is going to be 700. Relevant cost is going to be 700. So we are done with the cost, relevant cost of material. So we go to relevant cost of labor. Do you have any question? Okay. For material C and D, for material C and D, I'll take that again. Material C and D. Material C is not in regular use at all. It is not in regular use. And since it is not in regular use, the relevant cost is going to be the higher of the current resale value or the value we will get for putting into alternative use. But we don't have any alternative use to put C into. So the value is going to be what? Current resale value. Which the value we are looking at to be at current resale value is going to be the one we have in store. So the one we have in store is 700. So it's going to be 700 multiplied by 2.5, 1,750. Then the remaining shortage, which we have to go to the market to get, is 300. And the current market price, which is the replacement cost, is 4. So we have 4 multiplied by 3, that's 1,002, plus 1,750, which is 2,950. Okay, material D is used in another job as substitute for 300 units of material E. As substitute for 300 of material E, which currently costs 5 naira. Now, the question here as to if it is not in regular use for D also is no. And here we get the information to compare both the current resale value and the replacement cost. Now, the current resale value of the material we have in store, resale value is 6, but we have to compare it to the cost we would have gotten for putting it into alternative use. So now, if we don't use D for this special order and we don't sell it, we would use it to produce E, which is currently in demand and will be needing 300. However, the 300 unit of material D needed does not concern you at all. Just know that you are working with D, does not affect you. So the value you will get for putting material D into alternative use is 5. And when you compare the cost of putting into alternative use, which is 5, to the realizable value, which is the current resale value, which is 6, you see that the current resale value is higher than the cost of putting into the value you will get for putting into alternative use, which makes the relevant cost of material D 6 naira per kg multiplied by 200 naira. So we have 1,002. We have 1,002. So, Mr. Chris, I hope that answers the question. I should explain material B again. Okay. I said material B. How many do we need? We need 1,000 units of material B, and we have 600 in stock, which simply means we still need 400 extra. So the 400 we need extra, we have to get it in the market, which is going to be at the current replacement cost. It's going to be at current replacement cost. Now, the 600 in store, what is going to be the value of the 600 we have in store? Because we know that the 400 is going to be at current replacement cost. Now, we need to check the footnote to see what we have. The information we have as regards B. They said B is in regular use. And don't forget, the first question is, material, are you in store? Material B answer and say, oh, I am in store. The answer is yes. We move on and ask the next question. Material B, are you in regular use or not? Material B said, yes, I am in regular use. And if a material is in regular use, the relevant cost of such material is the current replacement cost, because when you use it, you have to buy it and replace it back for the next production. Now, the 600 in store, you have to replace it back because material B is in regular use. And to replace it back is going to be at what? At 5 naira per unit. So the 600 you have in store is going to be at 5 naira per unit, which is 3,000. And the 400 also, which you have to go and buy outside, is going to be at 5 naira, which is 2,000. So 3,000 plus 2,000 gives us 5,000. Give us 5,000. So I've answered your question, Mr. Chris. So let's move on to the relevant cost of labor. And I've answered your question too. Tamoji, that I hope it's now clear. I hope it's clear now. I've explained it again. So we can move on. So the relevant cost of labor, relevant cost of labor, the relevant cost of labor, they said the relevant cost of labor depends on scenarios. It actually depends on scenarios and it is best explained with examples. So let's look at this example one to see what is going to be our relevant cost. The question says, Adeguru is currently deciding whether to undertake a new contract. Adeguru is currently deciding whether to undertake a new contract. 15 hours of labor will be required for the contract. So for the new contract, we are assuming in this case, Adeguru has a business and produces normally. Produces normally. However, they have a special contract, a new contract, which is totally different from the normal production they do. 15-hour labor hours is now needed for the special contract. 15 hours of labor is needed for the special contract. Ade currently produces product N. That is what they currently produce. Standard cost details of which are as follows. They have material A, direct material, direct labor, the selling price, the contribution. Now, requirement A says, what is the relevant cost of labor if the labor must be hired outside the organization? What is the relevant cost of labor if the labor must be hired outside the organization? It is very, very simple. How many hours do they need? They need 15 hours on the new job, on the new contract. And what is the rate paid by hour to labor? They pay 6 naira per hour. That means that is the amount they will pay if they are gone outside to get the labor, to hire the labor. So the relevant cost here is going to be the 6 they are going to pay per hour multiplied by how many hours are they working on the new contract. Labor will work 15 hours. So 15 times 6 gives us 90. 15 times 6 gives us 90. Gives us 90. Okay, can move on. Requirement B. They say, what is the relevant cost of labor if Adeguru expects to have 5 hours spare capacity? If they are to have 5 hours spare capacity, 5 hours spare capacity, what is going to be the relevant cost? It simply means that they need 15 hours for the special contract. However, 10 hours already, they have 10 hours already, which means they only need, no, they have 5 hours spare capacity, which means they need 10 more hours, 10 more hours of labor to work on that project, on that new contract. So to do that now, the 5 hours they have as spare capacity, the relevant cost is going to be nil, going to be zero, because it's like they are not doing anything. They have the spare capacity to work 5 hours. There's spare capacity to work 5 hours. The 10 hours is what you now have to go and hire people to come and work for you. So the first 5 hours, which is the spare capacity, is going to be at 0. Then the 10 hours is going to be at 6, which is the direct labor rate. Direct labor rate, which is going to be at direct labor rate. direct labor, which is 6. 6 times 10 to give us 6 times 10 give us 60. 6 times 10 gives us 60. It gives us 60. 60. It gives us 60. So for C, they say what is the relevant cost of labor if labor is in short supply? What is the relevant cost of labor if labor is in short supply? Now, if labor is in short supply, the relevant cost of labor is going to be, that means they have to pick labor, they have to take labor from producing the product L they are working on and take them to the new contract we want to work on or are currently working on. And as such, the cost of labor is going to involve opportunity cost. It is going to involve opportunity cost. The relevant cost of labor for requirement C is going to involve opportunity cost, and I need to work this out. So the relevant cost of labor is going to be the labor cost normally, which is going to be 6 multiplied by 15 hours plus opportunity cost. Now, the opportunity cost now in this case is going to be contribution per limiting factor. So what you are going to do is to first of all get the contribution contributed by the product. Contribution caused by the project, the contribution is 22. Now, we now see that the limiting factor in this case now is labor. And what is the number of hours required for labor? Number of hours required per unit of labor, per unit of limiting factor is 5 hours. Is 5 hours. So when you divide this, 22 divided by 5, you have 4.4. So the opportunity cost is going to be 4.4 at 15 hours that you'll be needing for the new project, because the labor will be working 15 hours on the new project. This is 90, then 4.4 times 15, and this is 66. So what do we have? We have 156. So I can move on. Please, I'm in the next example. Kindly check, can you check the material? I'm in the next example. Kindly check the material with you for the next example. Okay, what spare capacity means is you have enough strength, enough resources to be able to carry on to do something. That's what we mean by spare capacity. So when I say, can you please borrow me 100,000? And I say, having considered all your expenses, do you have the spare capacity to give me such amount. That's what we mean by spare capacity. That is, can you give me that thing without having to go extra mile? Do you have the capacity to do such a thing? Do you have the capacity to do such a thing? So that is what we mean by spare capacity. That's what we mean by spare capacity. And when and short supply, I don't understand short supply again. So let me move on to the next question and solve. You say if it's in short supply means they don't have any capacity at all. They don't have any capacity either. They can't even spare you one. They can't even spare you 1 hour of the labor. That's what it mean by spare capacity. They can't spare you one at all. So that is what we mean by spare capacity. So I believe we have the question, but I will read the question out. Okay, let me switch my screen to the question. Then I will switch again to the solution. So they said the question says success club approach a company for the production of 1,000 special plates to mark the anniversary of the club. The accountant of the club has provided information in the unit cost as follows: direct material, direct labor, variable overhead, depreciation, fixed overhead, sundry fixed cost, cost per unit. This is the quotation that is being given by the accountant, that is given by the cost accountant. So look at the footnote. Look at the footnote. You are further informed that the company normally produces 10,000 plates per annum. In order to produce the special plate, overtime premium will have to be incurred. In order to produce the special plate, look at that English. In order to produce the special plate, overtime premium will have to be incurred, and when it is shared among the 11 plates, the average share is 2 naira. You are required to calculate the relevant cost of the company of producing 1,000 special plates. Now, in this question now the first relevant cost here is material, labor is relevant, variable overhead is relevant, depreciation it is not relevant, sundry fixed cost is not relevant, and the 2 naira overtime premium is also relevant. Relevant cost of special order. So we have the material, we have the labor, we have the overhead and overtime premium. So for the material, the cost is 10 naira and they are producing 10. Labor cost is 7.5. One thousand. Overhead is 2.5. The premium is 2 also. This is going to be 10,000. This is 7,005. This is 2,005. And we have 2,000 naira. So the total cost will be 10,000. Which gives us 22,000. So any question? So no question, we can move on. Okay, we're moving on. So the next on our list is, so I'm sharing this slide to the question. That is where we'll be doing it going forward. So the next thing we are doing now is make or buy decision, accept or reject decision. So make or buy decision, he said this will occur when the manufacturer is faced with the decision as to whether to produce in-house or subcontract the production to outside contractor, or to purchase some part outside the organization. If an organization has chosen about whether to make internally or buy externally and has no scarce resources. Now, without reading all of this out, let me just explain in simple terms. What we're trying to say is there are some companies, some companies they produce, and they might have some special order also. They might have some special order also, which if they want to look at it very well, they have to conclude if they have to give it to an organization smaller than they are that can do it for them, and they will give it to the customer. That is, they will get a contract and they might not have the time or capacity to do it. What they will do is they will not tell the customer that they cannot do it. They will accept it, but they have to evaluate it and see, is this thing going to be okay for us to do in-house, or we should give it to an outsider that will do it for us. That is the basic idea about make or buy. Now, they have to consider so many factors for them to be able to accept to give it to an outsider, because when you give it to the customer will not know that you've outsourced it also. They will believe you've done it yourself. So we have to look at the relevant cost of making it and the relevant cost of what? Of buying it. So we have the qualitative and quantitative factors to consider for the two. So the quantitative factors to consider is the cost of in-house, the cost that can be saved if you are not making that product. So all variable cost of making that product is going to be relevant. Specific fixed cost also is going to be relevant. Opportunity cost is going to be relevant as well. Then you compare it with the purchase price. You compare with the purchase price. The lower of the two is what you are going to pick. So the cost of making it will be the variable cost plus the specific fixed cost plus opportunity cost. Then you compare it with the cost, the purchase price, the amount you would have gotten it from the third party. Do you understand? So you have a customer, yourself, and other outsourcing firm also which you can buy from. Then some qualitative factor you consider is the quality of the product to be supplied, because when they give you substandard product, when they give you substandard product when they give you substandard product, the customer will not believe that the customer will not believe that you outsource it. They are going to believe that you produce it yourself. Another thing is the reliability of the supplier. Can you rely on the supplier to produce in 3 days? Effect or future of market prices also. The possible adverse effect of revealing trade secrets. So these are the factors we look at. They are the factors we look at. So look at this example very well. Let's take a moment to study this example ourselves. I'm going to give us 1 minute to study this example. Study the example very well. Okay, so they said the company makes 4 components WXYZ, for which costs in the forthcoming year are expected to be as follows. Production units, these are the units to be produced. We have the marginal cost, the direct material, labor, and variable overhead. They said the directly attributable fixed cost per annum and committed fixed cost are as follows. Costs that are incurred as a direct consequence of making W, incurred as a direct consequence of making X, incurred as a direct consequence of making Y. Incurred as a direct consequence of making Z. We said direct fixed costs or specific fixed costs are relevant costs. While other committed costs are what? Irrelevant costs. Should the company make or buy the component? Should the company make or buy the component? We have to see. We have to see if they should make or buy the component. Let me share my screen back. I'm sharing my screen. Please make sure you have the question with you. So the cost of making, we have material, labor, overhead, and we have specific fixed costs. We have product, W, X, Y, and Z. So I have the units to be produced, 1,000, 2,000, 4,000, 3,000. This is 1,000, this is 2,000, 4,000, and this is 3,000 units. So what is the cost per unit? Variable cost. Variable cost per unit. Let's use the total variable cost per unit. Use the total variable cost per unit because we have to navigate going through everything. Total variable cost per unit is 14, 17, 14 for W, 14 for W, 17 for X. Let me see if it's something you can copy. So the cost of material for product W is 4, and 4 times 4 times 1,000 is 4,000. For X is 5. That gives us 5 naira per unit. That's 10,000 multiplied by 2,000. That's 10,000. Then for Y is 2. 4,000 times 2, that's 8,000. Then lastly is 4. 4 times 3,000 is 12,000. We go to cost of labor. Cost of labor is 8,946. 8 times 1,000 is 8,000. 9 times 2,000 is 18,000. 4 times 4,000 is 16,000. Then 6 times 3,000 is 18,000. Overhead. Cost of overhead is 2,312. 2,312. 2,3. So this is 2 times this, 2,000. 1 times 2,000 is 2,000. 2, 3 is 3. 3 times 2,000 is 6,000. Then 1 times 4,000 is 4,000. 2 times 3,000 is 6,000. So specific costs incurred as a result of specific costs incurred as a result of each product being produced is 1,000, 5,000, 6,000, 8,000, 1,568. 1, 5, 6, 8. So we get the total cost. Total cost that's the total cost. So the unit, to get the unit cost, we have to divide by the unit produced. Unit produced. So this 1,000, 2,000, is 4,000, and this 3,000. So we get the cost per unit. When we do that, we have is equals to this So we have to compare with the cost, the purchase cost of buying from outside, and cost of purchase. Check the question. What is the cost of purchase? 12, 21, 10, 14. 12, 21, 10, 14. 12, 21, 10, 14. So we now come arrive at a decision. For product W, the cost of making in-house is 15. The cost of purchasing from outside is 12. So here we buy rather than make. Here the cost of purchasing is 21, while the cost of producing is 19.5. So here we make. Also for Y, the cost of producing is 8.5, while the cost of purchase is 10, which means cost of purchase is higher than cost of producing in-house. So here we make as well. So also for Z, the cost of purchasing is 14, while the cost of producing in-house is 14.67. So here also the cost of purchasing is lesser than the cost of producing. So what do we do here? We buy. So that's it. Shared my workings. So let's move to accept or reject an offer. So I've changed my screen back. So we're moving to accept or reject decision. Accept or reject decision. So accept or reject decision. It is a decision that involves accepting or rejecting a special order made by a customer. So there are cases whereby we will have a special order by the customer. We now have to sit down and decide if it is a worthwhile, if it will be going to be worthwhile to accept the decision or not. So in doing that, we need to follow some guide. One of it is, do we have the capacity? Is the company working below capacity? What then by working below capacity? What we are trying to say is, to the facility of the company, is it being underutilized at the moment? That is, let's say we have a machine that we use to produce, and the machine can produce 10,000 units in a month, and we are currently producing 5,000 units. That means we have capacity. We are working below capacity. We still have extra capacity to be able to meet the number of units the machine can produce. That's what we mean by are we working below capacity or not? Now we need to ask, are we working below capacity? Does the company have excess capacity which is can do the job? And is there alternative use of the excess capacity? That is, what can we use the excess capacity to do? That is the 5,000 in this case now, the example I cited. Does the price paid cover marginal cost? Marginal cost are incremental cost, they are variable cost. I said it in our first during our first day. The price, the minimum price to know if to accept a project, accept a contract or not, is that it must be able to cover the marginal cost, which are the incremental cost. Incremental cost. And let's take a look at this example. Let's take a look at this example. So Kilo Shell Nigeria Limited manufactured a single product for ladies called the slimming stick. A stick sells for 20 kobo. A stick sells for 20 kobo. Their current output is 400,000 sticks, which represent 80% level of capacity. They are producing 400,000 sticks, which is about 80% of your capacity. That is, they still have 20% extra capacity. So they have capacity 20%, and will get it 20%. A customer recently placed an order at 130K per slimming stick. Total cost for the period were 56,000, of which 16,000 were fixed cost. This represents a total cost of 14 kobo per timing stick. You are required, based on the above information, advise Ilon-Shell Nigeria Limited whether or not to accept the offer. Now, if you look at this question now, they tell you that Ilon-Shell produces stick and normally they sell that stick for 20 kobo. Now, they have current output of 400,000, which represent 80% of their capacity, which means they still have 20% capacity. They have capacity, no problem. They now said a customer has recently placed an order to pay 13 kobo. And don't forget, we said one of the things you need to look at to know if you are to accept a contract or not is to ask if there is capacity. And they told us that there is capacity. However, this question is not that explicit because they did not tell us the number of units wanted by the customer. If they have told us, we will need to compare what is the amount of extra capacity they have and what is the number of units that is required by the customer. We will now see if we really have the capacity to meet all of the customers' demand. But here, they didn't tell us that. They just told us that they have capacity. Okay, we've accepted. Now, the second thing we have to consider is, can the money being paid by the customer cover the marginal cost, which is the incremental cost and the variable cost now? We need to check. They've told us that the total cost of the product is 56,000 in a period, of which 16,000 is a fixed cost. So the 16,000 is not moving in proportion with the level of activity. It's just the variable cost we have to consider. And to do that, we have to deduct fixed cost from the total cost to get the variable cost, because total cost is a function of total variable cost plus total fixed cost. So from what they've done now, the total cost, looking at total cost divided by the unit produced, it gives 14 kobo per sliming stick. 14 kobo per sliming stick, but it's the variable cost that we look at now, the variable cost. So to do that, I have to change my screen to the solution. So total cost 56,000. Total variable cost, total fixed cost rather, 16,000. And we all agree that total cost is a function of total variable cost plus total fixed cost. So if we are to get the total variable cost now, we have to do what? We have to deduct the total fixed cost from the total cost. And how do we do that? Say 56,000, we take 16,000 from 56,000, and that gives us 40,000. This 40,000 is what represents the total variable cost. And now see how many units were produced when we incurred 40,000 units produced, 400,000 units. That gives us cost per unit of 10 kobo. And the customer is willing to offer 13 kobo. So if you look at it, are we going to accept it or not? Because the amount the customer is willing to offer covers the variable cost, it covers the marginal cost. So in this case now, the decision is going to be what? Accept the offer. Decision is going to be accept the offer. So we are looking at delete or retain a segment. Delete or retain a segment. Delete or retain a segment. When a company manufactures more than one product, there will be tendency to apportion fixed costs to all products produced. This apportionment may be done arbitrarily, that is, may be done arbitrarily, making a product to report a loss. Now, what I'm trying to say here is when a company produces more than a product, it is very, very important for them to absorb the fixed cost, the overhead cost into into the product. Now, taking this cost away from the contribution might result into a loss, and it gives the management the feeling that that particular product is not making profit, and as such is not something we should continue with. But when you are faced with this kind of scenario, it is important to base your decision on contribution, because if a product is giving a positive contribution, it is okay quantitatively. Only if you want to look at other qualitative factors. Now, to do that now, the following guide in deciding whether to delete or retain a segment. One, general or apportioned fixed cost should not be used for such decision. Any fixed cost that is not specific to that product should not be used in making decision as to whether to continue the product or not. In a situation whereby fixed cost is unavoidable, general fixed cost, any product generating positive contribution will not be advised to be dropped. Yes, whereby in a situation whereby the fixed cost is an unavoidable fixed cost, you cannot use profit to judge such a business if it is making a loss. You can't use such yardsticks, such metrics to judge that business, because regardless that fixed cost is going to be incurred. However, that contribution is going to help you reduce the burden of that fixed cost, because let's say we have product A and B. Product A is giving you 1,000 contribution, is giving you 1,000 contribution, and product B is giving you 2,000 contribution, and the allocated fixed cost for the both of them is say 2,000. That means product A will have 1,000 loss, product B will have no profit. Now, if you delete that segment, when you delete that segment, that fixed cost of 2,000 is still going to be incurred, and you have to take it on B, which makes B to make a loss of 2,000, because the new fixed cost that will be taken by product B will be 4,000. Deducted from the 2,000 contribution, that will give you 4,000 loss. However, if you have product A giving you a contribution, positive contribution, it is going to help you reduce the effect of that fixed cost on your overall profit of the business. That is it. And alternatively, if the product can be replaced with a more profitable product, yes. If you can add another product which is more profitable than the product in question, you can delete it regardless, even if it is generating a very very encouraging contribution. But if the product you are bringing in can contribute more, then you can delete such segments. So let's look at this example. They say the company manufactures three products: product P, Q, R and B. Product P, Q, R and B. The present annual income from this is as follows. The company is concerned about poor profit performance and is considering whether or not to cease selling R, that is, stop the sales of R, which is giving a loss of 3,000 naira. It is felt that selling price cannot raise or lower without adversely affecting net income. 5,000 of the fixed cost of R are direct fixed costs which will not be saved. If the product ceased, there are some attributable fixed costs. That is, there are some attributable fixed costs. All other fixed costs are to remain the same should the product be discontinued or retained. Now, they are telling us that product R has fixed cost of 18,000. It has a fixed cost of 18,000. And if you look at it well, only 5,000 of that fixed cost is related to producing product R, which means let's see, if it is going to already, it has a contribution of 15,000 naira, which is a good one, so let's see how we can do it. Let's see if it is going to work. Let me do for R, P, R, what's the other, PRB. What's the contribution? Contribution is 20,000, 15,000, 25,000. I actually only need for B to know if it's to continue, for R rather, to know if it is to continue R is going to be okay or not. So specific fixed cost, 5,000. When we deduct it, we have difference of 10,000 naira. So we still have a profit of 10,000 naira. R is still having a profit of 10,000 naira. Now, if you look at it very well, regardless of if R is produced or not, there is a general fixed cost of 13,000 naira. That is the 18,000 for product R, which is the given to product R, minus the 5,000, which is the specific out of the 18,000. When you take the 5,000 away, you have 13,000 that will have to be spread on P and B, and it's going to reduce the profit of the total profit of the organization. It's going to reduce the total profit of the organization. So it is advisable that product R is retained and not decision. It is advisable that product R is retained and not discontinued. Retained. Okay, I said product R. It does not need to be, it needs to be retained because it is contributing, it has a contribution of 10,000 naira, contributing a contribution worth 10,000 naira. Now, if you delete product R, there is still general fixed cost of 13,000 naira that will still be incurred regardless. Which product R, contribution by product R is suppressing on the total profit, because when you take away that 10,000 contributed as 50,000 contributed, in reality is 10,000 because the specific fixed cost attributable to product R is 5,000. When you deduct it from the contribution, e give you 10,000. That 10,000 should have helped you to reduce that general fixed cost, but if you delete it, it will not in any way help you reduce it, and it's going to be a burden to the two products, because when a cost is shared by three people, it's not going to be the same thing as when a cost is shared by two people. That is what I'm trying to explain. Okay, so we're moving to limiting factor. Just give me a moment. Limiting factor. Okay, so let me explain the concept of limiting factor. Limiting factor is is that thing that does not make an organization to fully achieve its corporate goals and objectives. There are there are resources, limited resources, that does not make the company achieve its corporate goal and objective. And you look at it and be like, a company requires so percentage, so number of resources, and they cannot get it. Are they going to just fold arms and be like, oh, we can't get these resources, let's go, let's slow down our business? No, that will not be the case. But what they need to do is just to make sure they manage that resources and get the best use of that resources, get the best out of such resources. That is what they can do. That is the only thing that they can do. So now, if you look at it very well, when you look at it very well, limiting factor can be anything. It can be material, can be labor hours, can be machine hours, can be anything. Just think of it. So when you have a limiting factor question, what do you do? The first question you have to do is to identify the limiting factor. Identify limiting factor. After identification of limiting factor, the next thing you will do is to calculate your contribution. Calculate your contribution for all products. After you've calculated your contribution for all products, you then will now get the limiting factor per unit. You've identified the limiting factor. What is the number of limiting factor per unit? If limiting factor is labor, how many labor hours do you need to produce one unit? That is what we mean by limiting factor per unit. After that, you divide the limiting factor by the contribution you've calculated. Then you will rank based on the limiting factor per contribution per limiting factor that you've gotten, contribution per limiting factor that you have gotten. You will calculate that. Then you now allocate the hours based on that. Now let me just chip in some things. Now, if you have one limiting factor, what we use is this method. If one factor is the limiting factor, what we use is um this method. If you have more than one limiting factor, what you are going to use is what we call linear programming. Linear programming. If you have more than one limiting factor, what the method you use is what we call the linear programming. And that is, what do? You find the objective function, and your objective, the business objective, is either to maximize profit or to minimize cost. But in this case, we want to maximize profit. And what do? We want to maximize contribution. It's contribution we want to maximize. So you write out your contribution per unit, representing it with each product. That is your objective function. You want to maximize your contribution. Then that contribution you want to maximize, which is your objective function, is subject to, then you now begin to list each of the you now begin to list, okay, material. How many units of material is available? How many units of material do you need for product A? How many units of material do you need for product B? Then you now write, if it is restricted to say like 1,000, you say is equals to or less than, is less than or equal to 1,000. That's for linear programming. That's for linear programming. Also, this thing can also lead you to throughput accounting, and that was what they tested in number 1, November 2016. They mixed it with limiting factor and throughput accounting. They mixed throughput accounting and limiting factor. So we are going to work that through now. After this question, we go to the past question and solve question. Now, last diet, what they did was that they give a question that looks like two potential limiting factor, but it is required that you have to test first. Please, in everything you do, make sure you test for limiting factor. And that is the reason I'll be teaching you the two methods for you to test. There is a popular method for you to test, but I can already tested another method of testing, and that was about 6 marks for that diet, just testing alone in percentage. I'm going to work, we are going to work on that also. But let's solve this question that we have with us. But before we move on, if you have any question, please in 2 minutes. I'll take question before we move on. 2 minutes. If there's no question too, you can signify by saying by writing no question. So let's look at this question together. Let's take a look at this question. Said Aki Limited produces three products. Product A, B, and C. 2,000 direct labor hours is available, and the production data is given below. Selling price, variable cost, contribution, the labor hours unit to be produced. All figures are assumed to be correct. The question says advise the management on which product to be produced. Advise the management on which product. So I have product X, Y, Z. Said we first identify the limiting factor, but they already gave us the limiting factor already. Okay, let's see. Let's have a test. A test. Let's have a test. Product X, product Y, and Z. Product X needs 6 hours per unit. 6 hours, and will be producing 300, 300 units. And we're producing 300 units. We're producing 300 units. Product Y will be needing 4 hours and will be producing 300 units as well. That Z will be needing 2 hours producing 400 units. So here will be 6 hours multiplied by 300 units. That's 1008. 4 hours multiplied by 300 units for Y. That's 1002 hours. And 2 hours multiplied by 400 units. That is 800 hours. So when we get the total, it's 3,800 hours. And this is the total required hours. However, the available hours is 2,100, which simply means we do not have enough hours. We do not have enough labor hours. All this shortfall, the difference between this, so we need extra 1,007 hours to be able to make 300 unit of X, 300 unit of Y, and 400 unit of Z. So are we going to say because of this we will not produce? No. So we have to work with what we have. By doing what? We've identified our limiting factor to be direct labor. So next thing we do is to get our contribution. And the contribution we have from the question, we're giving contribution directly. So another way you can actually get your contribution other than selling price minus variable cost is saying your fixed cost plus profit, or you say your fixed cost minus loss. Also, you might be given something called CMR. You can actually do your workings from there. Or when they tell you that um when they tell you that there's a way they might put, I think I saw it in one past question, 2017 November, 2017 November. They said, I think the selling price was about, the selling price was about 64% of the total sales, and which invariably makes the contribution to be 36%. 36%, yes, of the, yes, okay, the variable cost is 64%, which makes the contribution 36%. So they can, getting your contribution can come in diverse ways, can come in different ways. It can come as simple as saying selling price minus minus variable cost, or you say your fixed cost plus profit. You can also say your fixed cost minus the loss you've gotten, or you might be given in percentage as well. So you can get contribution in like 4 ways. And also this material testing for limiting factor. This is one popular way you can get it. So there was a diet, like I said, that was 2016 November diet. they changed the way limiting factor to check for limiting factor, and it was awarded 6 marks just to test for limiting factor. But the thing was, before that time, many people just know how to get it using this way. So after this question, we are going to solve the past question. You are going to see how you can go about it if they come this way or if they are going through the other way too. So what is the contribution given to us? We have 18, we have 16 for y, and we have 13 for z. Now what is the limiting factor per unit? Limiting factor per unit. We've identified limiting factor to be labor. So what we are asking is, how many labor hours do we need to produce 1 unit of y? How many labor hours do we need to produce 1 unit of x? And how many labor hours do we need to produce 1 unit of z? That is what we're asking. Limiting factor. Okay, I'll share the screen back to the solution now. So your shortfall should be negative. Simply means we don't have enough. So we have 6, 4, and 2. So the next thing we get is contribution. A limiting factor. So we are going to divide it and say 18 divided by 6, 16 divided by 4, then 13 divided by 2. So we come here to rank. Our ranking now, see that the one that give the highest contribution per limiting factor is product Z. Then we say what? That would be the first person we consider when we are to allocate the limiting factor. And the next person or the next product is Y, which is going to be the second. Then X, the third product we consider. I hope you can see my screen now, my solution screen. Okay, that was 127, 5 minutes ago. Okay, so now we have to allocate the 2,000 hours available, 2,000 labor hours available to the product and see the contribution we can get. Although they didn't ask us to calculate the contribution from the optimal product mix, but then we'll do it. Now you see that the available hours is 2,100 labor hours, and Product Z, which have the highest contribution per limiting factor to be 6.5, needs about 800 hours. 800 hours. 800 hours. So we come here and say the labor hours required. Come here and say product labor hours required. Labor hours required. We have the labor hours available. So product Z, okay, then we can have the units produced. The unit that can be produced. So labor hours required by product Z is 800. And available hours is 2001. 2001. So when you deduct 800 from 2001, what we have left is 800. We have 1003 left. 1003 left. 1003 labor hours left. With this 800 hours, product Z can conveniently produce 400 units. Can conveniently produce 400 units. And the next in line is Y. And Y needs how many hours? Y needs just 1002. Product Y, 1002. When you deduct 1002 from 1300, you have 100 left. You have 100 left. Now, if you look at X, product X need product X need 1008 hours, but we have just 100 hours left, and it requires 6 hours per unit. How many hours, how many units can product X produce with the available hours? What we just need to do is we have 100 hours available. That is the available hours after we've given products Z and Y. And we need to know how many labor hours is required per unit to produce product X. It is 6 hours. 6. So to do that now, it is going to be the available hours left divided by the number of hours required per unit of product X. Per unit of product X. So it's going to take up the whole of 100. If you take the whole 100, number of units it can produce is going to be equals to 100 divided by 6 hours it takes per unit of product X. It can produce 16.67 units, approximately 17 units. Approximately 17 units. So the product you need to be produced is going to be X, Y. X is equals to let's say 17, Y, Y 300, Y 300, and Z will be 400. So let's check the contribution, product X, Y, Z. What the unit they can produce? 17, 300, 400. Contribution per unit. Contribution per unit for X is 3, so it's 18 rather, for Y 16, for Z 13. The total if they had given us the fixed cost, we would have deducted the fixed cost from total contribution, but since they didn't give us, just leave it that this way. So the total contribution that will be generated from the optimal product mix is going to be equals to 10,306 naira. 10,306 naira. So I believe we are okay with this. If you have any question, kindly indicate in the comment box. So without wasting our time, let's take a look at last diet question number 1 and see the part where we need to do on limiting factor. Oh, somebody called our attention to contribution for Z to be 12 instead of the 13 that we used. Okay, so it has changed. So we have 9,906 instead of 10,000. Thank you very much. So let's take a look at number one question. Last diet, May 2021. May 2021. Okay. He said the managing director of Natams Manufacturing Limited, located in Lagos, attached a seminar titled Optimizing Scarce Resources Utility in a Manufacturing Setting with particular reference to linear programming. And I can tell you for free, this is where each problem of some students starts because they saw linear programming and many jumped into solving linear programming. However, we don't even know yet. Let's continue. But the fact that a particular subtopic was mentioned in a question does not mean you just have to run into it directly. So let's continue. They said on his return after 3 days of the program, he called for a management meeting to discuss his experiences at the seminar in view of the board decision to produce two major products in the coming years. The following information are made from the work of a research team conducted by a group of external research experts. The expected products are Biggie and Smalley. The expected product are what? Biggie and Smalley. So they want to produce Biggie and they want to also produce Smalley. The expected cost statistics are as follows: material, labour, machining time, other processing time. All figures are assumed to be correct. The company expects a pricing policy that is aimed on total cost of production plus 20% markup plus 20% markup. Don't forget, markup is a profit expressed as a percentage of cost. So as you are giving markup, you can express it directly on cost. But if you are giving margin, that is profit expressed as a percentage of selling price. If you are giving margin and all you have is cost, you have to first convert your margin to markup. But in this case now, we don't need to convert anything. We are giving markup directly and we have the cost. So we just express the markup on the cost. We add it, whatever answer we get, we add to the selling price, to the cost, and we get our selling price. Then from there, we can do whatever thing we want to do. That is that about the 20%, and that's what we need the 20% for. Other than that, we don't need it again. The company further expects to incur overhead annual period overhead of 10 million with normal production expectation of 200,000 units of Biggie and 100,000 units of Smalley, absorbing overhead on 2 to 3 basis respectively. It is expected that in the forthcoming year, the company will have the following resources available: material 1.8 kg, machining time 800,000 hours, and machine order processing time 1.4 million hours, 1,400,000 hours. So you are required as the management accountant, so you are seeing yourself as the management accountant now, to briefly explain the concept of linear programming and its usefulness. They are telling you to briefly explain the concept of linear programming and its usefulness. So like I said earlier, linear programming is used to solve solution where there is scarcity of available resources, or the resources you use in achieving the corporate goals and objective of the entity. And I told you the steps which you take when you are trying to solve linear programming question. I said the first thing you have to do is to get your objective function. And what are you trying to do with objective function? You want to try and maximize your contribution. You try and maximize your contribution. So the first thing you do is get your contribution per unit, then represent each product by any alphabet, so that when you are writing the contribution, you'll be able to write it alongside it and know, okay, oh, this contribution I'm writing as in my objective function is for this product, which is represented as either Y or Z or any alphabet whatsoever. It asks for the usefulness of linear programming. It can be used as a means of control. It is used to calculate if there is any slack or surplus. Yes, you can use to know if you have a slack or if you have a surplus. Also, it can be used in calculate getting transfer price. The transfer price, it can be used in budget and budgetary control as well. So these are the usefulness of linear programming. So now we go to question 2. We go to requirement 2. It says compute the prices that will be adopted by the company for the two products using the company pricing policy. Now, we know that basically your price is a function of your total cost plus the profit margin. Now, we have the total cost given to us, and we are given the pricing policy of the company, which is 20% markup. 20% markup. So let's start. Let me open a new sheet for this. So do the company have do they have a name? I think they are called N or something. That's the name of the company. So requirement 2 rather says that we should compute profit for each product. Profit for each product. What are the two products we have? We have Biggie and Smally. big E and small e. So we look at the cost of material. The cost of material given is given in the question. You don't need to stress over it. So material for big E is 250, 250. The cost of material for small e is 150. We're not doing anything spectacular. I'm just writing what they've given us in the question. I have labor also. We have the machine time. Machine time. Machine time for big E, the cost is 60 naira, while for small e is 30 naira. Also, for processing time, for processing, the cost for big E is 40, while the cost for big E for small e is the cost for big E is 50. We have to consider overhead too, because we said the price is a function of total cost. So for the overhead, they said it incurred an annual period overhead of 10 million with normal production expectation of 200,000 units of biggie and 100,000 units of smallie, absorbing the overhead on 3-2 basis respectively, absorbing it on 2-3 basis respectively. So we have to work on the overhead. overhead cost. Overhead cost for biggie going to be 40 and 30. So now we can now add the markup of 20%. But we have to get the total of the cost. Total cost. Okay, let me find somewhere around there and say workings overhead. So the total overhead cost is 10 million. 10 million, and they said is to be divided on the basis of 2 to 3. On the basis of 2 to 3. So if you are to divide the overhead on the basis of 2 to 3, then we say biggie going to be 2, since two of them want to share and biggie is taking 2 and smally has to take 3. It is going to be, for biggie now, it's going to be 2 over 2 plus 3 multiplied by the 10 million. They are to share the overhead on the basis of 2 to 3. That is, biggie will take 2 over 5. And how do they arrive at that 5? It is by adding biggie, what biggie and smally will be taking together as the denominator. So we have 2 over 2 plus 3 multiplied by 10 million. Then for smally too, same thing. It's going to be 3 divided by 2 plus 3 multiplied by 10 million. So now this is going to give us 2 divided by 5 multiplied by 10 million. And this is 4 million. And this is 6 million. So what we need is the overhead per unit. So we now go on and check how many units, what is the budgeted quantity. The budgeted quantity given to us in this question is 100 and 200 respectively. 100,000 units rather, and 200,000 respectively. So when we go on and say I can now come here and say overhead per unit. The overhead per unit now is going to be, I'll do for biggie, it's the spelling of biggie. How did they even spell that biggie? Smally. So the cost attributable to biggie is 4 million, and the quantity, budgeted quantity is 100,000. While for smally, the fixed cost attributable, or the overhead rather, is 6 million. While the budgeted quantity is 200,000. When you do that, we have 40 naira here, and for here we have 30 naira. I hope it is clear now. So the total cost is equals to, we add all of this together: material, machine time, processing time, and overhead cost. We add them together. Then the same thing for smally. So if I'm to express 20% on 390, what do I have? So 20% of 390, I told you it's because it is markup that we're charging it direct. If it were to be margin, we have to convert to markup before we can express on cost. So for biggie, we have 78. Then for smally, we have 52. 52. So we have gotten our total cost and we have gotten our profit margin. So the addition of the two gives us our selling price. It gives selling price. So we can add the two together. Here we have 468 for biggie. Then for smally, we have 312. That's just what they require us to do for number 2. That's the requirement number 2. So let's see what they want us to do. Requirement 3. So what we just did now is just 5 marks. They said advise the company on the output that needs to be produced to maximize its total profit, supporting your answer with full financial analysis. Can you imagine? This question did not tell you do limiting factor, and that is where people will begin to say they don't even know what to do. They don't know what to do. Now, this question has talked about linear programming. Oh, there's a mixed up. It should be 3:2 and not 2:3. So this will be 6 million. And this will be 4 million. Thank you very much. Thank you. So if this is 6, we're still going to get the same answer actually. Thank you. This is going to be 2. Here we have 30. And also, here we have 4. And this is 1. We're still going to get Thank you very much. Thank you. This should give us 30 and this should be 40. So 30%, 380 times 20, it should be 76. And it should be 54. Thank you, thank you, thank you. So, like I was saying, this question was not really, it did not really say, okay, do limiting factor, and you just saw 10 marks, and people will be like, where do I even start from? What do I do? You don't need to do anything special. Yeah, just look at the question. The question I just told you about linear programming, the requirement A, and you've been able to answer the requirement A, you've done requirement B, you have 10 marks already, then you are about to add 20 marks, another 10 marks rather, to make it 20 marks out of probably 90 something marks that you are looking for. And you begin to look, what do they expect me to do here? See, you have all of these things. They gave you an hint here. They say it is expected in the forthcoming year, the company will have the following resources available. When we are talking about linear programming and limiting factor, we talked about resources being available and resources being required. So they now give you material. The first thing you should come to your mind is question has told you something which should lead to your answer. Please, the next thing that should come to your head is to let me test for linear for limiting factor and see if I have just limiting one limiting factor or I have two limiting factor. So let's go and check. So I say check. Check. The first thing there is material. Material. We are going to check for biggie and also check for smallie. Please pardon the way I spell biggie. I'm just now for biggie, okay, let me do it this way. Biggie, smallie. So for biggie, biggie needs how many unit of material? How many kg of material? Biggie needs 5 kg. 5 kg of material, which is to be sold. And which how many units does it need to sell? The budgeted quantity, 100,000, which will give me a total of 500,000. Also, smallie will be needing 3 kg. All of these are in the question. Multiplied by 200,000 units. So when you add this all, this is 600,000. When we add this up, It is going to give us this is the required material. Required material. Then what is the available material? Available material given to us is 1008 kg, which simply means that we still have surplus of about 700 kg. So now we just calculated and see that material is not the limiting factor because we have more than enough material. We still have about 700,000 kg. So we still have surplus. We are still operating below capacity with material. So again, we check for machine hour. Machine hour, we still maintain the biggie. Okay, for biggie, let me represent as B, then small I represent as S. It needs just 4 hours of machine hour multiplied by 100,000 that needs to be produced. And small e needs 2 hours multiplied by the 200,000 that needs to be produced. This is 400,000 hours. And this is another 400,000 hours, which is total 800,000 hours. This is the available, or this is the required rather. And the available machine hour is 800 hours. So when we deduct it, we are neither working at full capacity or below capacity. We are at par. It's balanced. This is zero. That's what they will mark to give you 10 marks. Please note this. In this case, they are going to mark it to give you because they said you should support your answer with full analysis. The unit of biggie is 100, while the unit of small is 200. Unit of biggie is 100, while the unit of smally is 200. Is correct. We didn't mix it up. That is absolutely correct. Absolutely correct. We didn't mix anything up. So I test for order processing time. Order processing time big is represented as B, small is represented as S. Okay, the composition of BD should be 100. Okay, we mix the composition up again. So this should be 300. What we have is we have 500,000 kg surplus, 500,000 kg surplus. Here also 200, I have 800, 100, I have 200. This is going to be 1 million. So we have deficit of 200,000. So for that processing time, thank you very much. Thank you for the thank you for bringing to our notice the mix up. So for Biggie, other processing time needs for Biggie need 4 hours of other processing time multiplied by 200,000. Then Smalley needs 5 hours of other processing time multiplied by 100,000. So this is going to be 800,000 and this is going to be 500,000. So the required is going to be 1,300,000, while the available is 1.4 million. So we have a surplus of 100,000 hours. So we just did and confirm that machine hour is the what? Is the limiting factor. Machine hour is the limiting factor. So having identified the limiting factor now, we have gotten like say 2 3 marks. We can now go on and calculate contribution. So we say contribution. But before I calculate my overhead, what was given to me was even contribution now. So to save our time, so let me just copy this table. Let me copy the table down. So I have a selling price. Selling price. Selling price we got for Biggie was 456. 456 for Biggie. Then what did you get for Smalley? 325. 324. All of this should be minus. Minus. This also is minus because it is cost. This is minus. And this is minus. So if you don't want to go through this route, you can just go through fixed cost plus um, fixed cost plus profit. 456 minus 250 minus 60 minus 40 minus 250 minus 60 minus 40. This gives me 106 by 234 minus 150 minus 30 minus 50. And this is 94. This is the contribution. So if you want to look at other ways to get that contribution too, when you say see that our overhead cost here is a fixed cost. If you say 30 plus 76, which is the profit, it will give you 106. And if you say 54 plus 40, it will give you 94. So it is still the same thing. But you can do it and you can get the contribution whichever way you want to get it. So I now say contribution, limiting factor per unit. Limiting factor per unit. Now, the limiting factor is material. So how many units of material is required? Sorry, the limiting factor is machine hour. Machine hour, sorry, machine hour. So how many machine hours is required for Biggie per unit? 4 hours. And 2 hours is required for Smalley. What do we get? Contribution and limiting factor. So when I divide 106 by 4, I have 26.5, and 94 divided by 2, I have 47. 47. So when I rank, which one comes first? So small e comes first, but it has the highest contribution per limiting factor. Then big E second. So now we can now calculate the optimal product mix, and we'll do a check on others too so that it will not affect others. We'll do a check on others. So we move to the optimal product mix. Optimal product mix now. The available hours for machine hour is 800,000 hours. 800,000 hours. So from our analysis, we are producing small first. So small needs how many hours? Small needs 200 hours. Yes, for machine hour 100 hours. So when you deduct 200 from this, and with 200 hours, Smalley can produce or will produce 100,000 units. Hundred thousand units. When you deduct this, the available hours become 600,000 hours. So Biggie, Biggie needs 800, but he can't get 800 because the available hours here is what? Is 600. So it will take up the whole 600 to take everything. It's going to take everything. Having done that, what we need to now know is how many units can Biggie produce with 600 available hours. So what we do is it requires 4 units, 4 hours rather, of machine hour to produce 1 unit. So what we are going to do is we'll divide the available hours by the number of hours it's needed per unit. So it is going to be equals to 600,000 hours divided by 4 to be able to produce 150,000 units instead of the budgeted 200,000 units. So I'll come here and say contribution, total contribution that can be generated, total contribution that can be generated will be equals to biggie and smallie. So biggie can produce 150,000 units and its contribution per unit is 106. So when you multiply 150,000 by 106, you have 15,900,000. 15 million. Also for smallie can produce 100,000 multiplied by 94 naira per unit. This is 9.4. When you add the two together, it gives you total contribution. Then you can take away the fixed cost from it, right? The fixed cost, which is 10 million. So this is what is required of you. However, there's something we call slack and surplus. But this question does not really require us to do it. Slack and surplus. Let's just do it. Let me just do it. But in exam, you don't need it. You don't need it. But we are going to do it for the three. And what we mean by slack and surplus is that we are going to test if the optimal product mix we've gotten, which is 100,000 and 100,000 and 1,000 we've got, is not going to, when we combine it for material, the available material will be able to take care of it. The available labor will be able to take care of it, and the available machine hour and processing time will be able to take care of it. So let me start. Check for surplus, for slack. So material, you need to get the combination of the material first so that you know. For material, we have biggie and smallie. So biggie requires 5 kg and optimal product mix says biggie can produce 150,000. So 150,000 multiplied by 5, that's 750,000. Then biggie, smallie rather, smallie needs 3 kg. Smallie needs 3 kg and our optimal product mix we calculated say smallie can conveniently produce 100 kg even with limiting factor. This is going to be 300 kg needed. So when we add all this together, it becomes 1,050,000 kg. And the available number of material is what? 1,008. So we are still on point. So this is the material used. Then available. Available is 1,008, 1.8 million. So we have a surplus of 750 kg. So the same thing applies to machine hour. For machine hour, we say biggie and smallie. Biggie and smallie. So biggie needs how many machine hour per unit? 4. 4 hours multiplied by 200,000 units. It is 800,000. No, sorry. And produce according to our optimal product is 150. 150,000. 150 times 4, that's 600. This one is 2 hours multiplied by 100,000. This is 200,000. So when we add it together, we have 800,000. This is machine hour used. And available is the same thing, 800. No slack. There's no surplus. There's neither a, because at the end of the day, it gives us nil. 0. So we move for for machine hour. Okay, order processing time. We have biggie. And for biggie needs 4 hours of order processing time. 4 hours multiplied by is 200,000. No, 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 no. 150 according to optimal product mix. It is 600,000. Smally, smally requires smally requires how many units? How many hours of order processing time? It requires 5 hours of order processing time and 100,000. This is the order processing time used, and this is the available order processing time is 1.4 million hours. So we have 300 surplus. So what you just done still within our limiting factor. Okay, so that answers our question. So the next question says that the next question says that calculate the shadow prices of the constraints. Calculate shadow prices. So now, I was shadow price is just trying to tell us that what is the extra contribution we can generate by adding one additional lim- thing that is causing limiting factor. So what we're trying to say here now is what is the extra contribution we're going to generate if we can increase the machine hour, which is the labor, which is the limiting factor, by 1 hour. What is the contribution we can get? What is the contribution to get if we can increase that limiting factor by just 1 hour? And limiting factor here is machine hour. If we can increase it by 1 hour, what is the extra contribution that we can get? Okay, they said explain the meaning of shadow price and comment on the usefulness of its limit and its limitation. So that is what we use limiting factor to do. So the meaning of the shadow price. So its usefulness, it can be used in setting transfer price. It can be used in determining opportunity cost, especially transfer price. It is going to be very, very important. So let's see. Let's go on and wow, 7 marks. Calculating shadow price, 7 marks. Okay. It's a very, very simple thing to do. So our limiting factor is labor. Yeah, our limiting factor is labor. So what we're trying to now do is we're saying that how many units can be produced in excess of that 600 available hours we have here? 600 available hours. So what we do is, let's increase the available hours from 800 to from 800,000 to 800,001. So let's go again. Shadow price. We have the available hours to now be 800,001. So we are going to give Smally it's 200,000, producing 100,000 units. Then Biggie, then will be left is 600,001. So for Biggie will take the remaining 600,001, producing how many? So it is just going to be 600,001 divided by the number of machine hours required by Biggie per unit, which is 4. Which is 4. Which is 4. So we now get a new contribution. So the new contribution is going to be, let's say we have Biggie here, and have Smally here. So the unit for Biggie is this, while the unit for Smally is 100,000. Contribution per unit. Contribution per unit is 106.94. So total contribution is going to be this plus this. We have that. So we'll now compare it with the previous contribution. The previous contribution was this. 25,300,000. Previous contribution, so we bring it here. So the difference between the two is what we call the shadow price. And this is what they gave 7 marks. 7 marks. Can you see? So that's all. So that is all. So the other question there that is left is just the 8 marks question. So what they want you to do in E is just that they want you to do MPV, assume the company position in C is maintained. So we already calculated the cash flow. We already calculated the cash flow. Add the answer we got in C together. Take it as your cash flow every year. Then you assume that cash flow occurs the same thing every year. So what is the total cash flow we got for C? We had 15,300,000 as total. In this case now we can see it as cash flow because relevant fixed cost also can be is a relevant cost for capital budgeting, making capital budgeting decision. So you will assume this 15,300,000 occurs every year for 3 years, and you discount it using 15%, and your initial investment is going to be 45 million. That is what you do to get your 4 marks there. Then they say what is the break-even factor for this project? What they're asking for here is the internal rate of return. The internal rate of return, that is what they are asking for over there, internal rate of return. So you can do it and you can send to me. I'll give you feedback if it is right or wrong. So because of time, for us to be able to still do some other things, let me quickly analyze this question, this number one question that was tested 2016. I will quickly analyze it. If you have the time, you can attempt it and submit as well. Uh, I hope we don't have any question as regards what we just did. Any question whatsoever? Any question? Okay, the E. I said what they are asking for in E1 is they want you to do MPV, and you know the profit we got was 15,300,000. Now don't say because it is profit you now deduct fixed cost from it, because in getting your relevant cash flow for capital budgeting, it is important that you consider relevant fixed cost, and the fixed cost in this case now it's a relevant fixed cost as well. Yes, so what you just do is take the 15.3 million as your cash flow, take it as your cash flow, and take the 15.3 million as your cash flow, and you discount it for 3 years. You know, they say the price is for 3 years. So 15.3 million in year one, 15.3 million in year two, 15.3 million in year three. You discount it each year using 15%. And you are going to see your initial capital outlay to be 45 million. So the answer you get in your after you've discounted your cash flow, you deduct 45 million from it. That's your MPV. And I said what they are asking for as a break-even discounting factor is your internal rate of return, and you use the formula lower rate plus MPV you got using lower rate over MPV of the lower rate minus MPV you got using higher rate. You close your bracket, you open another bracket, higher rate minus lower rate. So that is it. And that is that our last direct question. So please, in 2 minutes time I will be explaining. I'll just give how to go about that November 2016 limiting factor question too. Somebody say can we go on a break? Yes, but let me just quickly explain that let me quickly explain that question, then yes, we can go on a break after that. Let me quickly explain that. So they said Esinta Limited makes three products: soy, milko, and yogurt. All the three products must be offered for sale each month in order to provide a complete market service. The products are fragile and their quality deteriorates rapidly shortly after production. The products are produced on two types of machine worked on by a single grade of labour. 50 direct labour are paid 80 naira per hour for a guaranteed minimum of 160 hours per month. All the products are first pasteurized on a machine type A and then finished and sealed on a machine type B. The machine hour required for each of the products are as follows: machine type A, machine type B. All figures are assumed to be correct. The capacity of the available type A and B are 6,000 hours and 5,000 hours per month. So now the question has told you that this is the available hours. So the first thing you need to do and you must do is to make sure you test for limiting factor. Is to test for what? Is to test for limiting factor. Is to test for limiting factor. They said details of the selling price, unit cost, and monthly demand for the three products are as follows. Thank God they gave you selling price, no issue. They gave you um selling price, they gave you other costs, and they gave you monthly demand. So this is a monthly demand you are going to use to test for your limiting factor. So for example now, for soy, you are going to check how many hours of machine type A does it need, type A machine does it need. You multiply it by 1,002. You look at the next product to Miko, also Miko. You look at how many number of machine type A hours does it need to produce one unit. You multiply by the number of units it wants to produce, and the same thing for the last product to other machine type A. You get the required hours. You deduct it from the available hours. You deduct from the available hours. So now they said calculate the monthly utilization rate for each product and explain which of the machine. Am I sharing my screen? Oh no, I'm not sharing screen. So they said calculate the monthly utilization rate. What they want to check here is what is the limiting factor. 6 marks, limiting factor. Limiting factor, that's what they want to check, is a bottleneck slash limiting factor. Using current system of marginal costing and contribution analysis to calculate maximum monthly output of the three products. This is the optimal product mix. Looking at after you've gotten the limiting factor per unit, you now go on to calculate your contribution, get the contribution per limiting factor, then you rank, you look at which one should come first, allocate the available limiting factor to it, then you go to the next until you exhaust the available limiting factor. Then they go on to say you should explain throughput accounting. So what throughput accounting is just talking about is it sees only material as variable cost. Other cost aside from material cost is seen as what? As factory cost, treated like a fixed cost. Do you understand? Then for the D is now saying what you have done in B, repeat the same thing in D. However, in getting your contribution, only material cost will be what? Will be a variable cost. Only material cost will be a variable cost. Then E, they say explain their throughput accounting approach. So that is just the way to go about the question. So let me see. And if you look at this last question also, you can attempt this same question. I'll be you can try to attempt this question. This is also a past question. If you look at the concept I've explained with you on relevant costing, it is still the same concept. Just try and attempt the same question. So we can now go on a break. We'll come back and finalize and finish up on standard on transfer pricing. So what's the time? This almost 5:30, 3:30. So we can meet up by 5:30. So you can come back to class by that time.